Wow, this is crazy. Are you seeing this? That dress though? AOC should start her own merch line. I'd rock that for my videos. Wait, how much was that dress? Never mind, I can't afford that. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the crazy video setup because this is Meet Kevin's studio and I feel like this is the perfect place to talk about this video because I want to talk about taxing the rich. It's been trending on the Twitter sphere, and more specifically, I want to talk about the Biden infrastructure bill because there's a few sneaky provisions that are really going to affect all of the investors, including and especially the crypto investors. So I'll get into that in a moment. But first, I just want to talk about the State of the Union, because I'm not really somebody who follows politics very closely. But the way I see it is that politicians aren't really focused on solving the big picture issues like unaffordable healthcare and homelessness and providing better education and more employment opportunities. Instead, we're passing financial surveillance laws that allows the IRS and the government to track transactions over $600. It gives them full access to your bank accounts if that's what they want to do. Here's the truth about the premise of taxing the rich. The truth is, we don't agree what it means to be rich in this country. Being rich, as defined by the government, is anyone making $400,000 a year or more. Now that's a ton of money. If you make $400K a year, you are definitely wealthy. But when we think about true wealth and truly being rich, we're mostly referring to billion-dollar corporations with their secret offshore bank accounts that are evading their taxes and their social responsibilities of paying their fair share. They're pillaging and plundering the resources from the world, right? And rightfully or wrongfully so, we refer to people like Jeffrey Bezos, Elon Musk, and Mark Zuckerberg because their fortunes have exponentially multiplied in the last 10 years. That's also mostly because they've invented technologies that have affected us on a global level. But their kind of fortune and their kind of wealth is very different than the wealth defined by our government. And here's why. A study in 2018 looked at the top 1% of earners, which in that year was anyone making $540,000 a year or more. That's a ton of money, right? Now, those people represented 21% of all the earned income. But get this, those people paid roughly 40% of all the federal income taxes that year. So just think about that. The top 1% paid for almost half of the taxes in this country. But now let's zoom out and include a lot more working class people. Let's look at the top 10% in 2018, which was anyone making $145,000 a year or more. They earned about 48% of all the earned income, but they paid roughly 71% of all the federal income taxes. So the actual fact is that the richest people in this country are the ones paying most of the taxes, and yet we can't seem to agree among us who here is the true rich. Think about it like this. Somebody who makes $400,000 a year in this country who is considered rich might be keeping only $200,000. Only $200,000. Yes, that is a lot of money. But that is a huge difference in the level of perception and quality of life that that person could have made with that extra $200,000, like argue with people on Twitter about it, or start up their small business venture. That's in comparison to somebody who's a billionaire for whom that 50% might not be relevant at all. Think about it like this. Somebody who has $0 in their wallet and somebody who has $10 million in their wallet. Huge difference, right? But those two are way closer to each other than somebody who has $10 million and $1 billion. Those two are hugely apart. There's an ocean between them. In terms of ratios, that's like comparing somebody who has $0 to $1 to $1,000, because $1 billion is 1,000 million. And so meanwhile in this country, we have the $0 guy and the dollar guy arguing with each other, and the $1,000 guy's like, I'm gonna let you two finish, but I rule the world now. So tax the rich. The real question becomes, how much is a fair share? Is it 80%? Is it 90%? Is it 99% of all taxes paid? Or is that the wrong question? Maybe we should be using the taxes we do pay and putting that into resources like education, so that early on in life, we'd be smart enough to understand that when politicians say, tax the rich, let's give everyone millions, we would know that that's not how the world works, and that's just something politicians say when they want to be popular. We'd also be smart enough to know that instead we should be using our tax money to give each other more opportunities to become wealthy. Now, I didn't make this YouTube video to give you the answer because the truth is, I don't know the answer. I'm not smart enough. If I was smart enough, I'd be sitting in a purple neon office with 15 monitors behind me running for office, but I'm not. But I do think until then, it's important to draw a very clear distinction between what it means to be rich and what it means to be ultra rich, to the point where you have a social responsibility to society. Now, I'm not a billionaire, nor do I have a billion-dollar company, and you probably don't either. But I think we can both safely agree that it's very easy to be generous with other people's money. But now, let's talk about the $3.5 trillion infrastructure deal, and I'm sure you've seen this all before, so I'll be very brief and I'll be very quick because there's a few controversial changes in there, especially for crypto and stock investors, that I'll go over very quick. But I just want to apologize for the whole philosophical thing about taxing the rich, but I do think it really ties into this nicely, and it does really make sense, I think. There's two main changes I want you to know about. There's tax the rich changes, which only affects the rich, and there's tax the rich changes, which will affect a lot more people than just the rich. So the first set of changes is a change to the ordinary income rate, which will go from 37% to 39.6%. And the second change is a change to the capital gains rate, which will go up as high as 25% or as high as 28.8%. to be determined. That's all the stuff you've heard about before. That's anyone making $400K a year or less will not be affected by any of this. Now let's get to the second set of changes, which will affect a lot more people. One of the new changes is that they're thinking of getting rid of the step up in cost basis. So right now, if you inherit a house from your parents, let's say they bought a house for $200,000 and it grew to $1 million and they passed and they decided to give it to you. Right now, under current rules, you would get to inherit that house at the new stepped up cost basis, which means at the $1 million, the price at which it was when they passed, which means if you go to sell that house, you wouldn't pay any taxes on it. But under the new rule, you would inherit that house at the old cost basis of $200,000, which means when they pass, if it's valued at $1 million, you would pay the difference on the $200,000 and the $1 million, which is $800,000 in capital gains taxes that you would have to pay. And this is true even if you have no intention of selling that house. You still have to pay taxes on that property the moment you receive it. And you could see how very quickly, if you're a middle-class family and you're not necessarily wealthy, you could be stuck with paying a tax bill that you can't afford. Another tax the rich provision that will affect a lot of people is an increase to the corporate tax rate, which will go up from 21% to 26.5%. And this is one of those things that makes for great politics, but not always great policy, because saying tax the greedy corporations sounds great, and we definitely need to in some cases, but it sometimes has unintended consequences like slower wage growth and lower stock returns. I think we can all agree that we don't want slower wage growth and lower stock returns because it affects everyone, not just rich people, but people trying to become rich, like the average investor. And arguably the biggest change to this whole infrastructure bill is how they want to treat crypto, which is more like any other asset class. They want to have stricter crypto reporting rules. And so here's the drama. Right now, they're trying to designate as many entities in the crypto space as brokers, which is fine, except the problem is their definition of what a broker is extremely broad, and that's a problem. Because what it said originally is any person who, for consideration, regularly provides any service responsible for effectuating transfers of digital assets, including any decentralized exchange or peer-to-peer marketplace, which means anyone who's a node, a miner, a developer, a decentralized exchange is now considered a broker, which means every single transaction and microtransaction would have to be not only reported on, but they'd also have to pay taxes on every transaction, which is economically nonsensical. Luckily, we had the Wyden-Loomis-Toomey Amendment, which excluded all of that, until the Warner-Portman Amendment was like, I'm gonna let you finish, but the banking industry had the greatest control of all time. So it's a mess, and we'll figure out exactly what happens when this bill passes, but none of these amendments actually are law yet, so we still have to wait and see. Those were some of the changes, and Congress tells us that we'll know the answer by September 27th, so we'll wait and see. But in the meantime, don't forget to have a great rest of your day. Smash the like button, subscribe if you haven't already. Go get up to $250 worth of free Bitcoin with this BlockFi link right here. Go get your 2 free stonks, and go track them automatically with this spreadsheet linked down below in my Patreon. Love you. Thank you so much for watching. I'll see you back here on Monday, Friday, sometimes a Wednesday. I'll see you soon. I'm gonna go bug Kevin.